Stats Canada just released the numbers for the Consumer Price Index for November. Inflation holding steady at 2.2%. CPI rising 0.1%, matching estimates. Here to discuss those numbers and what it means, Claire Fan, senior economist for RBC. Claire, thanks as always for joining us.
Thank you for having me.
Overall picture, the numbers, kind of what everybody was expecting, slightly lower, right?
Yeah, so the headline at 2.2 is actually exactly what we're expecting, but I think the details weren't quite as expected. For example, we've seen actually pretty big improvements in the Bank of Canada's core measures. So these are CPI trim and median that tend to not capture some of the other more volatile component. But the bad news is we also saw a pretty big increase in food inflation to the highest point since the end of 2023.
Okay, let's talk a little bit first about the trim and median. I was just reading, I thought they were going a little bit away from that, as not putting as much, having as much influence, the trim and median, but it's still, you still think it matters?
Yeah, for sure. I think it matters in an extent as to what it measures, which is the components of the consumer basket that the Bank of Canada can influence with monetary policy changes. And of course, these include mostly services components that's really both driven by demand. We're mostly demand side of the economy, which again, sort of interest rates can have a lot of sort of influence on. Versus if you were to look at food inflation, it's mostly, the surge that we've seen in November, for example, is driven by global, sometimes supply disruptions, which is, again, not something that the Bank of Canada can sway.
Yeah. Is that tariffs then having the impact? Is that what we're feeling with that?
Yeah, so tariff is a small part of the story. That's kind of how I would see it. So from the food inflation perspective, most of it is really, again, just, within Canada, drought conditions in parts of Western Canada, they're really thin. The cattle herd that drove up beef prices or beef inflation to over 17%.
Wow.
Outside of that, coffee prices as well. Yeah, coffee prices, you're going to like this number, is even higher, way over 25% on a year-over-year basis. Right, me either, actually. So a lot of sort of the coffee story is playing out globally. So we do see, for example, production and exports from countries like Brazil and Vietnam, which combined accounted for over half of global coffee production. Production is really soft, again, because of really hot and dry weather over the past couple of years. But tariff certainly is a part of the story as well. And this is something that we've been highlighting, which is that, even though there are not a lot of direct counter tariffs measures here in Canada, we can still see impact just because U.S. importers who are importing globally from other places are paying those tariff costs. And when they do re-export these products, for example, refined coffee products into Canada, prices will be inflated.
And with some of those grocery prices that you're talking about, beef, the droughts, any indicators how things are looking as we head into 2026? I'm kind of making you pull out a crystal ball on this one.
Yeah, so obviously supply disruptions, they're not just something that's been limited to this year. Like I said, it's been happening over the past couple of years, and sort of it takes a while essentially for cattle herds to start sort of growing again, for that inventory to start to build, for price growth to normalize. So unfortunately, at least in the near term, food inflation will likely still be a little bit more uncomfortable than we like to see.
And what were some of the stronger things that we saw for dropping that people will hopefully be feeling and enjoying a little more?
Right. So another essential item, which is shelter, right? So shelter inflation has come down a little bit. And if you were to look at the two key components when we think about shelter, one is rented accommodation. So rents started to grow a little bit slower, even though it's still pretty high at 4.7% year over year. And then the other component is homeowners, owned home accommodations. So a big one in that one is mortgage interest costs, and that component is continuing to moderate as well. And that's just because of the past Bank of Canada rate cuts that we've seen, 275 basis point, that will continue to flow through to support housing activity as well as driving sort of that mortgage interest component down.
And then big picture across the country, some areas hit harder than others for different things?
Yeah, exactly. So moving over to sort of the inflation outlook to 2026, or as far as Bank of Canada outlook goes, really, I think what the bank was expecting in the past, which was this kind of upside inflation pressure from trade reconfiguration to quote from the Bank of Canada, versus downside from just growing excess slack in the economy will continue to moderately offset each other. That's exactly what happened in November. And if this sort of trend were to persist into 2026, this is kind of the outlook for inflation that we and the Bank of Canada are holding. And this is why we don't expect there to be rate cuts or rate hikes really until 2027.
Yeah, there had been some talk of possibly a rate hike towards the end of the year, but you think that's being pushed back?
For sure. So I think risk to that kind of an outlook, which is headline inflation tracking around 2%, and the Bank of Canada is going to hold steady through the 2026, is to the upside. And mostly that's regarding inflation. So if we were to look at domestic demand, consumer spending has actually been incredibly strong this year, despite all the headwinds, including tariff uncertainty, including sharply slower population growth. Aggregate consumer demand is actually strong, and there's really not a lot of reason to expect that it will slow in 2026, and that's one of the key upsides to inflation that we see. And the other component, of course, is just the trade configuration costs. Already we're starting to see signs that it may be a bit more expensive or pricier than we were expecting. So given those risks, we do think that, if we have to say where the risks of balance are tilting, it will be tilted towards more inflation, not less, and sooner Bank of Canada rate hikes in 2026.
Okay. Claire, thanks as always for joining us.
Thank you, Roger.
Claire Fan is a senior economist for RBC.